Hello friends, welcome to Business Hologram YouTube channel. Today we are reviewing the company Mangal Electrical Industries Limited. First, let's get into the company overview part. So, Mangal Electrical Industries Limited is a Jaipur-based manufacturer specializing in power transmission and distribution equipment. The company transitioned to a public limited entity in 2024 and was listed on the BSE and NSE in August 2025. So, if you look at the core business and products of the company focuses on the processing of transformer components and the manufacturing of full-scale transformers. Their product portfolio includes transformer components, specialized cores, transformers, electrical accessories, and EPC services. So, if you look at the manufacturing infrastructure of the company operates five manufacturing units in Rajasthan, including facilities in the VKI area in Jaipur, in Sikar, and the Mahindra World City CES. It has certifications including ISO 9001 2015, ISO 14001 2015, ZED Silver, etc. Uh, if we look at the financial and market position, it is listed both in NSE and BSE. Its client base include the Jaipur Vidyut Vitran Nigam Limited and private players like Voltam Transformers. The company has a global reach and it is exported to several regions, including the USA, UAE, Netherlands, and Italy. So, if you look at the leadership, the company is led by Mr. Rahul Mangal, who is the chairman and managing director, who has over 35 years of experience in the power distribution sector. The executive team also includes Mr. Aniketa Mangal and Mr. Ombal Sharma, focusing on business development and strategic operations. So, if we look at the stock market details, the current share price of the company is 327.25 rupees per share. Market capitalization is 879 crores, which falls into the small cap segment. So if we look at the 52-week range of the stock price, the lowest price reached is 206 and the highest price touched is 573 rupees. As I already said, the IPO date of the company was on August 2025. Now let's look into the financial performance of the company for the last 4 quarters. As you can see in the screen, we have taken parameters like revenue, operating profit, net profit, and operating profit margin, and we're comparing with the last 4 quarters. So the key insights that we get from the data is first is revenue growth. The company showed consistent recovery in Q2 and Q3 of FY26 after a sharp seasonal dip in Q1 Q3. Q3 revenue grew by 6.2% year on year compared to the previous year's corresponding quarter. If we look at the profitability trends, while revenue has increased, net profit margin saw a slight contraction in the most recent quarter, largely due to an increase in operating expenses and raw material costs. If you look at the operational recovery, Q1 FY26 was notably weaker across all metrics, which is common in this sector due to the timing of government utility tenders and infrastructure project cycles. If you look at the yearly context, for the full year ending March 2025, the company reported a total revenue of 551 crores and a net profit of 47 crores, representing a significant 126% year-on-year profit growth from FY24. Now let's look at the strategic initiatives of the company. Since its listing in August 2025, Mangal Electrical Industries has launched several strategic initiatives focused on capacity expansion, technical upgradation, and product diversification to capitalize on India's booming power infrastructure. So, we will be focusing majorly on four strategic initiatives of the company. First one is capacity expansion and infrastructure. So, their focus is on the capacity expansion, that is utilizing IPO proceeds. The company is significantly expanding its facility in Sikar, Rajasthan. This includes major civil works to support higher production volumes. Next, their focus is on CRGO capacity hike. The company is increasing its effective capacity for cold rolled grain oriented steel, that is the CRGO steel. This expansion is slated for completion by January 2026 as per the latest investor updates. So it has reached its completion date. Next their strategic initiative they are following is product diversification. First, they are focusing on vacuum circuit breaker launch. A major strategic pivot is the entry into the VCB market. Development is currently underway with commercial production expected to start in the later half of FY26. This moves the company towards offering integrated electrical solutions beyond just transformers. Next, their focus is on high voltage market entry. The company recently secured PGCIL approval for transformer and reactor processing up to 765 kV class. This is a significant milestone that allows them to bid for higher margin, large scale national grid projects that were previously restricted to a few major players. Next strategic initiative of the company is operational and financial strengthening. Their first focus is on debt reduction. As part of its post IPO strategy, the company deployed 70 crores towards the repayment of outstanding borrowings. This has lowered finance cost and improved net profit margin. Next, their focus is on working capital optimization. Roughly 122 crore from the IPO was allocated to managing the high working capital requirements typically of the EPC, that is engineering, procurement and construction, and power equipment sectors. Next major strategic initiative of the company is strategic governance and compliance. Their focus is on leadership bench strength. In December 2025 and January 2026, the company appointed a new chief legal officer and company secretary and compliance officer to strengthen corporate governance as the newly listed public entity. Next, their focus is on backward integration. The company continues to prioritize its in-house model for CRGO lamination and core assembly by processing these raw materials themselves. They maintain a lower cost base and higher quality control compared to peers who outsource these components. Now let's look at the ownership structure of the company. As you can see in the screen, the promoter and the promoter group holds 74.79% of the shares. Retail and other public investors hold 18.58%. Domestic institutional investors 4.43%. Foreign institutional investors 2.2%. So the key insights that we get from the data is first is promoter stability. The promoter holding has seen a slight increase from 74.19% at the time of the IPO to the current 74.79. This high concentration suggests strong confidence from the founding Mangal family in the company's long-term trajectory. Next point, key point that we get from the data is institutional shift. Since the listing, there has been a notable decrease in institutional presence. FII holdings dropped from an initial 4.12% to 2.2%, and DII holdings decreased from 8.62% to 4.43%. This is often common in small cap stocks as pre-IPO investors or anchor investors exit after the lock-in periods or initial gains. Next is about the retail engagement. Public shareholding has expanded from 13.05% to 18.58%, indicating a growing interest from individual retail investors in the secondary market. So if we closely analyze the promoters, we can see that primarily the stocks are held by Mr. Ashish Mangal and Mr. Rahul Mangal and associated family entities and trusts. So if we analyze the DIIs who has invested, this includes small cap focused alternative investment funds and non-banking financial companies through specific major mutual fund houses currently have zero exposure because the mutual fund investment, the mutual fund holding the company is currently nil. Now let's move to the financial ratio analysis part. First we'll begin with the profitability ratios. So as you can see in the screen, we have taken parameters like return on equity, return on capital employed, net profit margin and operating profit margin. If you first is return on equity, the company's performance stands at 34.14 percentage, where the industry average is 18.5. Clearly, the company is an outperformer in this category. If you look at the ROCE value, the company's value stands at 29.3, where the industry average is 22. So in this segment is also the company is an outperformer. So in net profit margin case, the company's value stands at 8.4 percentage, where the industry average is 6.4, 6.5. So it's clearly it's maintaining an above average value. If you look at the operating profit margin, the company's value stands at 12.08, where the industry average is 10.5. So in this aspect also, the company is maintaining an above average value. So the key summary that we get from the profitability ratios that we have analyzed is strong operational outperformer. So Mangal Electrical Industries is currently outperforming the industry in terms of fundamental efficiency and maintainable margins. The primary risk factor remains its susceptibility to raw material price volatility and its intensive working capital needs. Now let's look at the leverage ratios of the company. First is debt to equity ratio. The company's value stands at 0.12, where the industry average is 0.85. So that value is exceptional. Next is interest coverage ratio. The company maintains a value 7, where the industry average is 4.5. So in that case also, the company is maintaining a very strong position. So the key summary that we can get from the data is the company is expansion ready. The current low leverage gives Mangal Electrical Industries financial flexibility needed to bid for larger EPC, that is engineering, procurement and construction contracts that require heavy bank guarantees. Next point is cost efficiency. Lower debt has directly contributed to the improvement in net profit margins, as interest outgo as a percentage of revenue has dropped from 4.2 percentage, that was pre IPO value, to approximately 2.7 percentage, that is the current value. Now let's look at the valuation ratios of the company. First is price to earnings ratio. The company's value stands at 19.83, where the industry average is 38.3. So the stock is undervalued. If you look at the price to book value, the company's value stands at 5.45, where the industry average is 12.2. So it is attractive when compared with the PB ratio. Next is price to sales ratio. The company's value stands at 1.6, where the industry average is 4.1. So in this case also, the company the value is significantly discounted. So the key summary that we can derive is on almost every valuation metric, MEIL is trading at a 30% to 50% discount relative to the industry, despite having superior efficiency ratios, which are ROE and ROCE. Now let's do a quick SWOT analysis of the company. First, we'll be focusing on the strengths of the company. So the first point under strengths is high voltage accreditation. Recently renewed PGCIL approval, which is valid until April 2029, to supply transformer and reactor components up to the 765 kV class. This places them in a niche group of suppliers capable of handling India's ultra high voltage transmission projects. Next strength they possess is integrated operations. The company handles the entire value chain from CRGO steel to CRGO steel slitting to final transformer assembly, which helps maintain higher margin compared to peers who outsource core components. Next point is deleveraged balance sheet. Post IPO debt repayment has brought the debt to equity ratio down to 0.12, providing a massive war chest for future capital expenditure without financial strain. Next strength is strong promoter skin in the game. Promoters have maintained or slightly increased their stake to 74.79% post listing, signaling long term commitment. Now let's analyze what are the weaknesses of the company. So the first point is geographic concentration. Manufacturing units are heavily concentrated in Rajasthan. While this offers local operational ease, it increases logistical costs for nationwide projects and exposes the firm to regional regulatory shifts. Next is working capital intensity. The business remains capital heavy with an elongated working capital cycle. typical of government utility contracts where payment cycles can be slow. Next point is seasonality. Quarterly results show significant volatility, often dependent on the timing of state discom tender approvals. Now let's see what are the opportunities in front of the company. So the first point that we have taken is product diversification. The launch of vacuum circuit breaker VCB product line in FY 26-27 allows the company to transition from a component or transformer manufacturer to a switchgear solution provider. Next point is renewable energy surge. India's push for 500 gigawatt of non-fossil fuel capacity by 2030 requires massive upgrades to substation infrastructure. MEIL 765 kV approval makes them a primary beneficiary. So next point is employee alignment. The newly launched ESOP 2025 plan is a strategic move to retain top-tier engineering talent in the competitive electrical sector. Now let's look at some of the threats the company may face. First is raw material volatility. Dependence on CRGO steel, much of which is imported or price linked to global indices, poses a risk to EBITDA margins if global steel prices spike. Next is competitive bidding. A shift towards e-reverse auctions by state utilities can lead to aggressive price bidding, potentially compressing margins for standard distribution transformers. Next point is market sentiment. Despite strong fundamentals, some research firms have maintained sell ratings due to a flat financial trend in early 2026, which could cap short term stock price appreciation. So friends, that was a short review of Mangal Electrical Industries Limited. So if you have found the video useful, please like, subscribe, share, comment and support. Thank you.